All right, let's jump right in. There's a massive power shift happening in the world of finance, but it's happening kind of quietly. A whole new class of lender has stepped out of the shadows and is, well, basically taking over. So in this explainer, we're going to break down exactly what's going on and why it's a change you absolutely need to understand.
And look, this isn't just some passing trend. That quote on your screen says it all. This is a permanent and growing force. We're talking about a fundamental, structural change in how businesses get the money they need to grow. So the big question is, what's really driving this permanent shift?
The rise of private credit didn't just happen by accident. It's the result of a power vacuum left behind by traditional banks, and that created an opportunity that has completely reshaped modern finance. To really get a grip on this new giant, we have to start with the old guard.
Right. So why is private credit so powerful today? Well, it all starts with the traditional banks, and why they essentially step back from the table. Their retreat is what opened the door for this whole new market to surge forward.
The whole story really kicks off after the 2008 financial crisis. A new set of global rules, known as Basel III, came into play, and in a nutshell, what these rules did was make it way more expensive and a lot less profitable for banks to hold certain kinds of corporate loans, especially for mid-sized companies. And just like that, a huge funding gap opened up in the market.
And the result of that? A really dramatic shift. Where banks were once the absolute go-to for corporate lending, private credit funds, which, by the way, don't have to play by those same strict rules, just swooped in to fill the void. They are now the primary financiers for countless business deals. This wasn't a temporary fix. It was a permanent realignment of the entire market.
Now, filling a market gap is one thing, but what makes this whole area so compelling is its ability to perform well no matter what the economy is doing. It's basically built to be an all-weather performer, and that resilience is key to its appeal.
This resilience really works in two main ways. First, in a world of rising interest rates, most of these loans have floating rates. That just means as central banks raise rates, the income paid to investors also goes up. It's a natural hedge. And what about during a recession? Well, lenders are in what's called a senior secured position. In plain English, if a company gets into trouble, they are first in line to be repaid. That's a powerful way to preserve capital.
But get this. That senior position isn't just a defensive shield. It can actually be an offensive tool. During a downturn, lenders can use what's called a loan-to-own strategy, which gives them the potential to acquire a company's assets at a discount if it defaults. It's a fascinating way to create opportunity directly from market volatility.
So we have a permanent market position and this incredible built-in resilience. Now let's connect that to what it actually means for an investor's portfolio. Why are so many people looking to add this to their strategy? It all comes down to something called the return premium. See, because these loans are more complex and you can't just buy and sell them on a public exchange like stocks, that's what we call illiquidity, investors get rewarded for taking on that complexity. They get paid a premium for it.
And that premium translates into a really significant difference in potential yields. As you can see, compared to more traditional public market bonds, the higher potential return from private credit is a major draw for investors who are looking for stable and attractive income streams.
So if we tie it all together, the core benefits for investors are pretty clear. You've got those higher potential yields, you get powerful diversification, since private credit doesn't tend to move in lockstep with public markets, and ultimately, all of that can help reduce the overall volatility and risk in a portfolio.
Okay, so when we bring all these pieces together, the bullish case for private credit becomes crystal clear. It really rests on three pillars: that permanent market gap left by the banks, its natural resilience to economic cycles, and of course, the attractive returns it can deliver.
And that brings us right back to where we started. This isn't some cyclical trend that's just going to fade away. The evidence strongly suggests this is a deep, structural shift, a permanent and growing force that has reshaped the landscape of corporate finance for the foreseeable future. Which leaves us with a final, pretty provocative thought. For years, this was considered an alternative investment. But given its size, its importance, and all its structural advantages, has it now become the new mainstream? It's a question that anyone watching the future of finance should be asking.